What's going on, everybody? Welcome back to the channel. In this video, I want to break down my current portfolio and kind of explain why I invest the way I do. Now, I'm going to go through my Roth IRA and my taxable brokerage account, kind of explain what I hold in each one, why I picked those investments, what they compare to, and some of the pros and cons. Now, I'm not making this video to tell anyone to copy my exact portfolio. Everyone has different goals, income, age, risk tolerance, and kind of just overall financial situations. This is just what I'm personally doing based on where I'm at right now. Now, the main idea behind my portfolio is pretty simple. I'm a long-term investor. I'm not trying to day trade. I'm not trying to time the market. I'm not trying to jump in or out of whatever is popular this month. I kind of want most of my money in investments that I can hold for years, keep adding to, and not really have to think about it every single day. And right now, just on a high level, my Roth IRA is 60% in VOO, 30% in QQQM, and 10% in individual stocks. And I have around $24,000 in that account. And my brokerage account is around 60% in VOO, 20% in VGT, 10% in gold and silver, and 10% in individual stocks, and I have around $9,100 in that account. Now, before I get into the actual investments, I think it's important to explain how I think about those two accounts. Now, my Roth IRA, this is like my long-term retirement account. So the way I look at it, this is money I do not plan to touch for a very long time. And because of that, I'm okay being more growth focused in this account. I'm also young, I have a lot of time left, and I'm not trying to use any of this money within the next year or even 5 years from now. And the big benefit of the Roth IRA is the tax advantage. I'm putting money in this account that has already been taxed. And if I follow the rules, the growth can eventually come out tax-free later. So if I believe certain investments can grow over decades, I like the idea of having that growth happen inside a Roth IRA. Now, my brokerage account is a little different. That account is still long-term for me, but it's a little bit more flexible, right? I can access this money before retirement age if need be. But the trade-off here is taxes. So if I sell something for a gain, that can create a taxable event. Dividends can also be taxable as well. So first up is my Roth IRA. Now, my Roth IRA is built a little bit around growth, and the breakdown, 60% VOO, 30% QQQM, and 10% into individual stocks. Now, VOO is the biggest position in my Roth IRA and my brokerage account, both making up 60%. And the reason is pretty simple for me. In my opinion, VOO is kind of like the foundation, right? It tracks the S&P 500. So every time I buy a share or an incremental amount, I'm basically getting exposure to 500 of the largest publicly traded companies in the United States. And while it doesn't give me exposure to the whole market, it gives me exposure to a lot of the biggest and most important businesses in the country. And for me, this is the boring part of the portfolio, but it's also the most important part. And another reason I really like VOO is because I don't have to guess which company is going to win, right? I don't have to pick the next big stock. I don't have to sit there and consistently ask myself if I should buy this company or buy that company or worry about options or day trading. I can just own a basket of very strong companies and keep adding to it over time. And it's also very similar to other S&P 500 funds like SPY, IVV, SPLG, or even VFIAX. Right? They all have small little differences, but the main idea is the same. They're trying to give you exposure to the S&P 500. Now, in my opinion, the pros of VOO is that it's simple, low cost, diversified across major US companies, and it's very easy to stick with. And for someone who wants to invest long term without making things overly complicated, this is a really important part of it. Now, probably the biggest con that people point out with VOO is that it's only US based large cap exposure. So you kind of miss out on two things. You don't have any exposure to small cap companies, and it also does not give you any international exposure. Also, because the S&P 500 is market cap weighted, the biggest companies can make up a very large part of the fund. So even though it sounds like you own 500 companies equally, you definitely do not. The next big holding in my Roth IRA is QQQM, which makes up around 30% of that account. Now, this is where I'm intentionally adding more growth exposure. Basically, this fund tracks the NASDAQ 100, so it's much more concentrated than VOO, and it leans heavily towards large growth companies, especially in tech and other innovation-driven areas. Now, the way I think about this fund is VOO is my core, QQQM gives me a little bit exposure to growth. And I think this fund is a great addition to my portfolio because I'm young and have a long time horizon. So I'm okay with potentially taking on a little bit more volatility if I believe in the long-term upside that's there. Now, a lot of people might say QQQM is very similar to QQQ. They're both based around the NASDAQ 100. The reason a lot of long-term investors like me actually like QQQM is because it is basically the more kind of buy and hold version, while only QQQ is more known for kind of trading and higher daily volume. Now, the pros of QQQM are that it gives you more exposure to large growth companies without once again needing to pick individual winners. So instead of trying to decide, which tech or growth company will do its best, I can own a group of them. Now, the con with this is it definitely has some overlap with VOO. A lot of the biggest companies in QQQM are already inside VOO. So by owning both, I'm not necessarily adding a completely different type of investment, which I'm fully aware of. I'm basically doubling down on certain large growth companies. And that can work really well when growth and tech are doing well, but also when those areas and sectors start to struggle, you can see some continued downtrend or volatility. And the last 10% of my Roth IRA is wrapped up into individual stocks. And this is the part of my account where I give myself a little bit more room to invest in companies that I personally believe in or want some exposure to. And I think that's important because a lot of people get into investing and immediately want to pick stocks. And I understand why. It's definitely more fun. It feels more personal. And it feels like you're actually kind of like contributing, like you're doing something. But the problem is individual stocks come with a lot more risk. Even if you like the company and even if the company is good or performing well, the stock can underperform. You can be a little too early, you can be a little too late, you can be wrong, businesses can change, the valuation could be too high, and there's just a lot of ways that this can end up going badly. So for me, that's why I only leave 10% of my individual stock picking bucket in there because it gives me enough room to own companies I like without putting my entire, financial future on the line. And the way I look at it is the ETFs are kind of like the foundation. The individual stocks are kind of the smaller bets that I have fun making and I'm allowed to do this. So currently, right now in my Roth IRA, the individual stocks I hold are AMD, Google, Amazon, Meta, and Microsoft. Now, they're not big positions. They're very small positions. A lot of them are in the Mag 7. A lot of these are already in VOO and are already in QQQM. But once again, it's a small part of my portfolio where I can potentially see a little bit of extra gains. So that's the pretty simple breakdown of my Roth IRA. Like I said, long-term investing, growth-oriented, pretty simple. Now for my brokerage account. Now the breakdown here, 60% VOO, 20% VGT, 10% gold and silver, 10% individual stocks. Me personally, I don't want my brokerage account to become a trading account. I still want it to be long-term investing focused. That way I can keep adding to it over time and still keep a relatively stress-free investing journey. That's why still, even in my brokerage account, VOO is the biggest piece of the puzzle because I want the core to be very simple. Then VGT gives me a more direct kind of tilt towards tech. I got gold and silver to kind of give me a small hedge against inflation or market downtrends. And I got individual stocks giving me a little bit more room for kind of personal fun and conviction. Now, I'm going to skip over VOO because it's the same exact thing as I mentioned in my Roth IRA. So we're going to go into VGT. Now, VGT is more directly based off technology exposures. So this is different from QQQM because as I mentioned prior, QQQM is the NASDAQ 100 exposure. So it includes a lot of large growth companies, but is not strictly a tech ETF, whereas VGT is specifically focused on information technology. So by owning VGT, I'm making a more kind of direct bet that technology will continue to be a major driver of growth in the long term. Now, the pros, pretty clear. If technology continues to grow and drive the market, VGT will absolutely benefit from that. Now, the cons of VGT are also very clear. It's super concentrated in tech, and it's not a complete portfolio by itself. So if tech had a bad stretch, VGT can get hit pretty hard. And because I already own VOO, and there is definitely some overlap, some of the biggest companies in VGT are also already inside VOO, which is a little bit of a downside as well, because once again, I'm kind of double dipping, which I'm fully aware of. Now, next up is the 10% of gold and silver. And this is probably the part where some people will either agree with or they'll be like, what are you doing buying gold and silver? And look, I do not own gold and silver because I think they're going to beat stocks forever and that, I think it's going to make me a millionaire. That's not the purpose for me. I own them because I like having a small part of my portfolio that is not directly tied to the stock market or company earnings, especially with as I mentioned to you guys, a lot of my stocks right now lean all into the US and mostly towards tech, right? So stocks are kind of the growth engines of that portfolio. Gold and silver, a little bit more of a hedge for me, right? They give me a little bit of diversification outside of just equities, and they can sometimes hold up differently during periods of uncertainty or inflation or etc. Now, the downside of gold and silver is that they don't produce cash flow. They do not grow earnings. They don't pay you like a business can pay you. So if you put too much money in there, you could drag down your long-term returns compared to owning productive assets like stocks. That's why I choose to keep it right at 10%. And just like my Roth IRA, I have individual stocks inside of my taxable brokerage account that I like to buy into, things I have conviction in, companies that I personally want to own to see the growth off of them. Now, I do understand, as I mentioned, that some of these individual stocks do fall within VOO, QQQM, or VGT. But as of right now, the individual stocks that I own inside my taxable brokerage are AMD, Meta, Amazon, SoFi, and Taiwan Semiconductor. So that is my full portfolio breakdown. Now, what I like most about my portfolio is just biasly, I understand it, right? And I know that sounds simple, but it does matter, right? I know why I own VOO. I know why I own QQQM, VGT, have a little bit of gold, have a little bit of silver, have some individual stocks. And because of that, I'm a lot less likely to panic or, randomly change everything when the market gets rough. I also like that the majority of the portfolio's ETFs, to me, that's a win because it keeps everything simple, makes everything consistent. I don't have to do a whole bunch of research on 30 different companies and try to guess what's going to happen next. Another thing I like is that I think it matches my personality, right? I want a simple foundation, but I also like having a little bit of extra growth exposure. And I know some people prefer like a total market fund or international funds or bonds and kind of a more traditional allocation. Now, I know this portfolio is not perfect by any means, right? The biggest weakness of this is probably the concentration in tech and US based stocks. And once again, I'm okay with that right now because I'm young and I'm focused on growth, but that does not mean that I should ignore the risk or potentially never make changes to this portfolio as time goes by. Another thing too is I'm fully aware that gold and silver may underperform stocks over long periods of time. So even though I like having them as a hedge, I also know that this could potentially drag my returns down if the stock market keeps performing very well. Once again, I am not trying to beat the market every single month. I'm not trying to trade headlines. I'm not trying to rebuild my portfolio every single time the internet gets excited about SpaceX, right? I would rather just have a good portfolio that I can understand and I can stick with rather than a perfect looking portfolio that I abandon every single 6 months. And that's really the whole point of this video, right? Your portfolio does not need to be complicated. It does not need to impress people. It does not need to have 40 different holdings, right? But you should know why you own what you own. So that is my current portfolio breakdown. Once again, very simple, growth focus, probably a little bit more tech heavy than some people would like to hear, and definitely not perfect, but it matches how I think about investing right now. Thank you guys for watching this video. I hope you guys have a great one. Drop your portfolio and what you hold in the comments down below. Let me know if you like my portfolio or if you don't like my portfolio, and I hope to see you guys in the next video. See ya.